Managerial Accounting students, ready for Chapter 9? This chapter we're going to get into flexible budgets and performance analysis. We're essentially building on the budgeting concepts that we learned in Chapter 8, but we need to consider some other factors. So here we go. So first, understand the basic variance analysis cycle. We prepare a performance report, which really a performance report is really just a fancy name for a budget versus actual report. We're going to compare our budget to our actual results. This chapter will learn in a little more detail how we should do that in terms of that performance report. Then we want to analyze any variances, any amounts that differ from our budget, whether it's over or under. We need to analyze those variances. Raise questions. It's not always good if we have come in under budget. Let's say we came in way under budget on our repairs and maintenance for our fleet of trucks. Should we be asking questions about that? I definitely have some questions. So coming in under budget on our expenses isn't always good. There's a reason we set aside money for repairs and maintenance on our trucks. What if that results in next month all of our trucks breaking down on the side of the road? So we definitely want to ask questions whether we're over or under budget. We want to identify root causes. And notice they say identify root causes. They don't say blame anyone, but essentially we need to get to the root of what happened and come up with a solution to fix it. Or we need to consider changing our budget. Maybe there's a problem that we need to address there. We take actions and then we go on about our business for the next period, and hopefully our next performance report looks better. So that's the basic cycle, and it all goes back to this idea of a process of continuous improvement. If we look at our variances, we ask questions, we identify the problems, those root causes, and then we take action. So we're constantly trying to improve our business through this cycle. So the first thing we need to do is look at our planning budget and understand what a flexible budget is and how they differ from one another. So a planning budget is prepared for one single level of activity. So that's also called a static budget. That's what we did in Chapter 8, was a planning budget. We started with a certain amount of sales, and then the rest of the budget fell in place based on that certain planned level of sales. Here's the problem though. Performance evaluation can be difficult when our actual activity differs from the planned level of activity. So maybe we didn't do $1 million in sales. Maybe we made it to $1.2 million in sales. So we exceeded our planned level of activity. That's great news, right? But what's that going to do to our expenses? Won't our expenses then be over budget? At least some of them probably should be. So how will we evaluate that? How do we know if we're doing well or not? So that's where the flexible budget comes in. So a flexible budget can be prepared for any activity level within the relevant range. So we may have had a goal for $1 million of sales, but if we were over or under that amount, then our flexible budget would help us figure out what our budget should be at our actual level of activity. So it shows costs that should have been incurred at the actual level of activity, enabling an apples to apples cost comparison. They refer to comparing our static budget or planning budget to our actual figures as an apples to oranges comparison. It's not a fair comparison. So when we use a flexible budget, now we're looking at apples to apples. So we look at our costs that should have been incurred at the actual level of activity. This is going to help managers better control costs in the organization and better understand what variances they need to pay attention to. So for example, if our sales exceeded the budget, we would expect that certain expenses are going to be over budget then. So that's not necessarily a bad thing. So we need to look at those variances in a little bit better detail to improve our performance evaluation. So we're going to look at Larry's Lawn Service. They provide lawn care in a planned community where all the lawns are about the same size. At the end of May, Larry prepared his June budget based on mowing 500 lawns. Since all of the lawns are similar in size, Larry felt that the number of lawns mowed in a month would be the best way to measure overall activity for the business. So Larry has put this together. So the number of lawns being 500 and he thinks his revenue is going to be 75Q, 75 times quantity 500. So can you imagine laying this out in Excel where these are formulas? Um, uh, so our wages are going to be 5,000 fixed plus 30Q. So we have a mixed cost, 5,000 fixed plus 30Q, which is our variable component. So 30 times 500, and we get a total of 20,000. Gas and supplies is 9Q, so a purely variable expense, 9 times 500. Equipment and maintenance, 3Q, and so on. And then we have these items down here that are fixed. Office and shop utilities, office and shop rent, equipment depreciation, and insurance. So these are just flat fixed amounts. And so we come up with total expenses of 32,500 and therefore net operating income of 5,000. Now remember, this is just a planning budget and it's based on one single level of activity. Then we have Larry's actual results. Well, look at this. He actually did 550 lawns. And if I skip down to the bottom, our net operating income is 6,450. Well, hey, let's just stop. We made more money than what we budgeted, right? Our net operating income on the budget was 5,000, and here we've got 6,450. So why bother looking at the rest of it? That's not good business. The question becomes, if we mowed an extra 50 lawns, what do we then expect our net operating income to be? Was 6,450 actually good, or are we coming up short here? So our overall revenue at this actual level of activity, 550 lawns, we brought in revenue of 43,000, and these are our actual expenses for the month, 36,550, and we get a net operating income of 6,450. So when we put these side by side, we're looking at actual versus planning or static budget, and we've put them side by side and put our variances over here. So we have a revenue variance of 5,500. We've got wages and salaries with a variance of 3,500. What are all these letters over here? FU, UFF, UUF. I hope you're thinking what I'm thinking. F and U stand for favorable and unfavorable. So our revenue has a favorable variance, meaning that our actual revenue was greater than our budgeted revenue. These first two expenses, wages and salaries and gas and supplies, were unfavorable. So these were unfavorable because we spent more than what we had planned. We have some other favorable variances down here. So when we think of favorable and unfavorable, I want you to think of it as your wallet. So is it favorable that you actually have $43,000 of revenue instead of $37,500? Yeah, that's favorable. I'd rather have more revenue. How about when it comes to expenses? So if I have $23,500 in wages and salaries expense versus $20,000 that was planned, is that good or bad? We spent too much money, right? So that's unfavorable. Ultimately, though, what we need to get at is why. And what this doesn't tell us is why. Since these variances here for wages and salaries and gas and supplies are unfavorable, does that mean that Larry did a poor job controlling his costs? And then these other expenses here, we've got favorable variances. Since these variances are favorable, does that mean Larry did a good job controlling the costs? Ultimately, from this comparison, we don't really know. What we do know is that we made more money than what our static budget or our planning budget indicated by $1,450. So overall, we're positive, favorable variance of $1,450, but we don't know why. Is it because we had a greater level of activity, or is it because we did a great job controlling our costs? So what we find out here is the deficiencies of the static or the planning budget. We can't answer this question because the actual level of activity is greater than the planned level of activity. Therefore, the actual variable costs are likely to be higher than planned variable costs, regardless of how well Larry did at controlling his costs, his managerial efficiency. So what we want to get at is how much of the cost variances are due to higher activity and how much are due to cost control. And in order to answer that question, we need to use a flexible budget. So we're going to flex the planning budget to accommodate the actual level of activity. So in a flexible budget, total variable costs change in direct proportion to changes in activity, and the total fixed costs are fixed. They remain unchanged within the relevant range. So you've heard me say that before. Guess what? The fixed costs are fixed, and the variable costs are going to vary. So let's redo Larry's lawn service budget using a flexible budget. And again, I'm hoping you can picture laying this out in Excel. We still have all these same revenue and cost formulas here. And if we drop in a different number of lawns up here, 550, we could let Excel compute our budget for us. And we could drop any number in there and these numbers could all update for us if we do this correctly. So now we're looking at a budget of 550, flexible budget, a level of 550 lawns. So we take 75 times Q, 550. So now we're expecting 41,250 in revenue, but our variable expenses go up as well. So we still have fixed wages of 5,000 plus 30 Q, 30 times 550. So our wages and salaries budget has gone up. Our gas and supplies budget would go up because that's 9Q. Equipment and maintenance, 3Q. So all of these variable expenses are going to go up because we have a higher level of activity. Q is higher. And then these fixed costs, office and shop utilities, office and shop rent, equipment depreciation, insurance, they're all fixed. They're not going to vary with our level of activity. So those numbers all stay the same. And according to this, we should have net operating income of 6,650 at this level of activity, 550 lawns. What should be the total wages and salaries cost if the flexible budget was for 600 lawns? Let's go back. So if this is our formula, 5,000 plus 30Q, and now they're saying Q, our number of lawns, would now be 600. Can you do that? 30 times 600 plus 5,000. What do you get? Hoping you came up with C, 23,000. So for our flexible budget, once we have those revenue and cost formulas, we should be able to quickly recompute our flexible budget at any level of activity, within the relevant range, of course. So then we need to take a better look at our variances. We need to understand why our variances are happening. Is it because of a change in the level of activity, or is it because we've done a great or a poor job managing our costs? So an activity variance arises solely due to the difference in the actual level of activity and the level of activity from the planning budget. So as we look at our flexible budget for Larry's lawn service, we're comparing our flexible budget to our original planning budget. So the flexible budget is not actual numbers, it's still just a budget, but we're comparing our flexible budget at the actual level of activity, and that's what's key here. So here's what we planned was at 500 lawns, but our flexible budget is going to be based on 550 lawns. And so what we come up with over here on the right is our activity variances. So how much of the variance is explained by 50 extra lawns? And the answer is 3,750 of revenue. And then notice that all of our expenses, the variable expenses, are all unfavorable. The fixed expenses is no change because they are fixed. And our total expense variance is 2,100 U. Now that's totally normal. We should anticipate an unfavorable expense variance when the level of activity increases from 500 up to 550 because it's going to cause all these variable expenses to then go up. So what we're hoping is that the activity variance in revenue exceeds the activity variance in expense. And that's what happens here. So based on this higher level of activity, 550 lawns, we're expecting 1650 more in net operating income. So that would be our total activity variance of 1650. So activity and revenue increased by 10%, right? To go from 500 up to 550 lawns, and to go from 37,500 in revenue up 3750 up to 41,250. So our activity and our revenue have increased by 10%, but our net operating income increases by more than that due to fixed costs, because all of these costs here were fixed and created no variance. So we have these variable costs to consider, but 50 more lawns made us more money. So that's our activity variance of 1650. Next, we need to take a look at our revenue and spending variances. So pretty much the same idea. A revenue variance is going to be the difference between our actual and our flexible, and our spending variance, again, is going to be the difference between our actual costs and our flexible budget costs. So let's go ahead and look at Larry's landscaping, comparing actual with the flexible budget. Notice we're not comparing actual with our planning budget anymore. When we do this, we're using the same level of activity. The flexible budget is based on 550 lawns, and of course our actual results is based on 550 lawns, because that's truly what happened. So here we're isolating our revenue and spending variances separate from our activity variances. So our revenue was 1750 higher than what we expected according to the flexible budget. So we made even more revenue than we thought. In terms of our wages and salaries, we're unfavorable. When we recompute our flexible budget based on 550 lawns, we should have 21,500 in wages and salaries, but our actual was 23,500. So we have an unfavorable variance there. Gas and supplies, also unfavorable. The flexible budget said based on 550 lawns, it should be 4,950, but the actual was 5,100. So these actual numbers, they're not formula driven. They're truly our costs for that month, where the flexible budget is driven by a formula. So we go through, we compute all these variances, again with the F's and the U's, favorables and unfavorables. I'm kind of wondering, well, what happened here? If I'm Larry, I want to know, well, we made extra money, right? We made an extra 1750. Maybe we took on some extra job. We had to remove a tree or remove a bunch of bushes, which is a little bit harder than mowing lawns. And we made extra revenue from doing it, but maybe it pushed our workers into overtime and we ended up spending too much on wages and salaries. So just that unfavorable variance there offsets any extra revenue that we made. So ultimately we add all of this up and we come out to 200 unfavorable. So as you're adding up this column of numbers, you treat favorable as positive numbers and unfavorable as negative numbers. So we come up with a revenue and spending variance of 200 meaning that at our higher level of activity, we didn't do a great job controlling our costs because we came up with an unfavorable variance. And we can isolate this and say this is not due to a change in level of activity. This is due to our ability to control our costs. So those are our spending variances, obviously. So the performance report is where we combine all of this together. So essentially we're going to be looking at both of these comparisons, the activity variance and the revenue and spending variances. And here's the typical format we're going to see. We lay out our actual, our flexible, and our planning budget. Okay. So you put your actual over here on the left, which you're going to compare to your flexible budget, and then in between is your revenue and spending variance. So how much of the difference can be explained by our ability to control our costs. And then you compare your flexible to your planning budget all the way over here on the right, and in between is your activity variance, which explains how much of the difference is caused by the change in level of activity. And what we see overall, remember at the very beginning we looked at our planning budget of 5,000 and our actual results of 6450. And we said, well, that's great. We came in above budget. Fantastic. But we asked the question, well, did we have more net operating income because we mowed more lawns, or did we have more net operating income because we did a great job controlling our costs? And what we find out is that that overall variance of 1450, well, we should have come in 1650 higher based on the activity variance, but we didn't do a great job controlling our costs, so we only came out with 6450. So we had a higher level of activity, but didn't do amazingly well in terms of controlling our costs. So we're breaking down that total variance of 1450 into 1650 favorable for activity and 200 unfavorable for revenue and spending. So yeah, they're pointing out the formulas. That's all fine. They're comparing the actual of 43,000 with our flexible budget of 41,250. We did all that already. In terms of your homework and your understanding of this chapter, this format here, essentially 5 columns, right? So we take our actual and our flexible, and in between we compare revenue and spending variances. And then we compare flexible and planning, and in between we compare our activity variances. That's the format you need to focus in on for this chapter, and make sure that you can understand what those comparisons are. So know that if you're comparing flexible versus actual, then we're talking about revenue and spending variances. Or if we're comparing planning versus flexible, we're talking about activity variances. When we talk about performance reports in nonprofit organizations, we definitely still should do budgets and performance reports in these organizations, but sometimes it's complicated because they might receive funds from sources other than sale of goods and services, and sometimes those funding inflows are not predictable. They may not be consistent, and some of them might be fixed or variable. So it kind of complicates things. Here they're saying a university, for example, it gets funding from the state, which is, it's a mixed funding. Probably some of it's fixed and some of it's based on number of students, that kind of thing. Tuition and fees collected, that's probably mostly variable. But then things like donations and endowments, that could be very tricky to predict. The endowments might be kind of fixed, but the donations might vary a lot. So harder to do this type of performance report for a nonprofit organization, but they still should do budgeting and look at performance reports. It's just a little bit different. We can also do a performance report just for a cost center. So even if we're not in charge of the revenue for the business, we still might do a performance report just in terms of managing costs in a certain department within our business. And again, same principles, we just wouldn't have any revenue, but we could still compare our activity variance and look at our spending variance and make sure that we isolate those two different variants to understand what differences are caused by change in level of activity versus which ones are caused by our ability to control our costs effectively. What about a flexible budget with more than one cost driver? We can do that. So sometimes more than one cost driver might be needed to explain all of the costs in an organization. And we've looked at this idea of having multiple cost drivers in previous chapters. So we can have cost formulas in our flexible budget that can be adjusted to recognize multiple cost drivers. So Larry's going to take another look at his budget. Because the time required for edging and trimming is different for different lawns, Larry decided to add an additional cost driver, which is going to be hours, for the time required edging and trimming. So Larry estimated the additional hours and developed a new flexible budget that includes a second cost driver, and he's going to use that in both his revenue and expense budget formulas. So here's what Larry's done. We still have numbers of lawns, which is Q, and then we're adding in numbers of hours, H. So his new formula, revenue, is going to be 75Q plus 25H. And then his wages and salaries, gasoline and supplies, and equipment and maintenance formulas have all been updated to factor in our two different cost drivers. And then still all these expenses down here are fixed. So based on this, our new flexible budget at a level of 550 lawns and 100 hours, our revenue should be $43,750. Our total expenses should be $36,250 and net operating income of $7,500. So again, you could probably picture laying this out in Excel where we could drop in appropriate numbers here for our actual level of activity, number of lawns and number of hours, and then our flexible budget would update accordingly. So some basic errors that we want to avoid in our performance reports when we're comparing budget and actual. A common error, I know you guys wouldn't do this, but others might, when preparing performance reports, are to implicitly assume that all costs are fixed or that all costs are variable. Well, neither of those things is true. If we were to assume that all costs were fixed, that's going to lead us to some faulty analysis. So first of all, here we're comparing our planning budget and our actual results. Should we do that? That results in that 1450 variance that we had from the very beginning. But what this doesn't help us understand is that variance because we have a greater level of activity versus our planning budget, or is it because we did a great job controlling our costs? So this is faulty analysis, assuming that at a higher level of activity that we don't need to update our planning budget, that everything's just fixed and that this is an okay comparison. This is what we call an apples to oranges comparison. We don't want to compare our planning budget with our actual results. We need to flex the planning budget and have a flexible budget based on our actual level of activity. So this would result in bad analysis. Common error number 2 is to assume that everything's variable. So that if our planning budget was for 500 lawns, but our actual is 550 lawns, well, that's a 10% increase. So we could just multiply everything by 110%, and that would be our new flexible budget. It's our planning budget times 110%, but that's not the correct way to prepare a flexible budget because it doesn't factor in these fixed items down here. Remember, office and shop utilities, office and shop rent, equipment depreciation, insurance, these were all fixed costs, and the planning budget shouldn't increase. Those were fixed. So they're assuming that everything here is variable and just multiply the whole thing by 110%. Also faulty analysis. So as we think of chapter 9 and the major takeaways here, I keep coming back to this particular slide. Focus in on this format, comparing actual versus flexible, which tells us our revenue and spending variances, and flexible versus planning, which tells us our activity variances. So we're breaking down our total variance of 1450 into 1650 favorable for activity. So we're going to make more money because we have a higher level of activity, but we missed the mark a little bit by $200 because we didn't do a great job controlling our costs. That tells a whole different story than just saying it's 1450 favorable. So keep coming back to this slide in terms of your overall understanding of chapter 9. All right, that's it. Let me know if you need any help or have any questions.